In this video, we'll be looking at the accounting concept of accounting for receivables. An account receivable is defined as an amount owed by a customer who has purchased a company's product or service. Receivables are generally the result of payment on account and are to be paid within a time frame. Uncollectible receivables include those payments which the company deems will be left unaccounted for in the long run due to customers not providing funds in the desired time frame, which, after being written off using one of the two methods, will then become a bad debt expense. There are two main methods of accounting for uncollectible receivables. The direct write-off method. This method is accounted for in one entry and involves a company recording bad debt expense when they determine they will be unable to collect the receivable. It is then written entirely off the books and recorded as a bad debt expense. However, the direct write-off method is prohibited in Australia under the generally accepted accounting principles for violating the matching principle, but it may be used for smaller businesses whose receivables are immaterial, meaning they cannot influence financial decisions. For example, Charlie makes a $6,000 sale for golf clubs on account to Phil on January 1. To record sales on account, he debits accounts receivable $6,000 and credits sales revenue $6,000. He would then debit bad debt expense $6,000 and credit accounts receivable $6,000 to record the bad debt expense and write off the receivable. Second, the allowance method. Completed using two separate entries, this method is the most accurate method of determining uncollectible receivables. It must be used if a company's receivables are material, meaning they can influence financial decisions. The first step involves recording an estimate of bad debt expense using an account named allowance for doubtful debts, which predicts the dollar amount to be uncollected. Secondly, it writes off the receivable when it is deemed uncollectible. For example, to record sales on account, they first debit accounts receivable $150,000 and credit sales revenue $150,000. They then debit bad debt expense $24,000 and credit allowance for doubtful debts $24,000 to record the bad debt expense, followed by debiting allowance for doubtful debts $15,000 and crediting accounts receivable $15,000 to record the write-off of the receivable. Further, there are three approaches used in determining the allowance for receivables. The percentage of credit sales approach estimates bad debt as a percentage of total credit sales. It is calculated by multiplying credit sales for the period by the percentage of receivables uncollectible estimated by the company. The percentage of receivables approach estimates bad debt expense as a percentage of the company's receivables balance. It is calculated by multiplying the receivables by the percentage estimated by the business to determine the expected account balance. Then the allowance account is adjusted to meet the balance. The aging of receivables approach recognizes that receivables become more uncollectible as time moves on. It is calculated by splitting the days after purchase in 30-day increments and multiplying them by increasing uncollectible percentages. To summarize, not all receivables can be collected by companies, leading to uncollectible receivables. The two methods used are the direct write-off method and the allowance method. And the three approaches used to estimate the uncollectible amount are the percentage of credit sales approach, the percentage of receivables approach, and the aging of receivables approach.